Enghouse Systems Limited is a Canadian software company that trades at the Toronto Stock Exchange, and its ticker is ENGH. The company currently trades at 62.55 Canadian dollars, and its beta sits at 0.85. Therefore, it is not as volatile as compared to the rest of the stock exchange. This company has got very close relatability to the core competencies, to the financials, and expansion strategies of Microsoft. Thereby, I think and I believe that this could be Canada's answer to Microsoft. The company's main products is to provide enterprise software solutions focusing on remote work, visual computing, and communications for next-generation software-defined networks. If the pandemic taught us anything, it is that remote work is the way of the future, and that the technology industry is a fast adapting, very flexible kind of industry, and thereby the reason actually that I am invested in the technology industry as well. One of the strategies of Enghouse that I find very similar to Microsoft's strategy as well is that the growth strategy of the company focuses on internal growth and acquisitions, which to date have been funded through operating cash flows. This therefore means that the company is financially stable, because then it does not have to issue so many shares into the stock market to fund its acquisitions, nor does it need to take on debt to grow its operations. As you see here, they mentioned that the company is well capitalized and have got nominal long-term debt. And again, guys, if you had been watching any of my video in the past that I have published, debt is something that I look very seriously into. And here another statement says that Enghouse is a cash buyer with significant cash on hand to finance its acquisition strategy. And this again is relatable to Microsoft. Microsoft is a cash buyer with significant amount of cash on hand to finance its internal growth and acquisitions. Another strategy of the company that I truly like is that it does not necessarily focus on America or Europe alone when it comes to its acquisitions, but it also has APAC or Asia Pacific as one of its desired geographies. America and Europe are stable markets, and therefore competition is steep and stable as well, whereas Asia Pacific is a burgeoning economy wherein population and the demand for Internet of Things is growing. These are the most recent acquisitions of Enghouse Systems. Just in 2019, the company acquired 6 companies, mainly from Europe and the USA and Canada. And the first quarter of 2020, the company acquired a company in the USA. And these acquisitions are mostly funded by cash, no debt, no shares issued. And this is certainly a good scenario here. You will find here that Enghouse bought or acquired the company called Video, and Video is a software for conferencing or video conferencing for remote work, and this product essentially propelled the company with significant revenue or sales growth in 2020 during the pandemic. Aside from geography, when it comes to acquisitions, the company targets companies that are already profitable, companies that would already have 5 million to 50 millions of revenue. The company should definitely have high barriers to entry, and therefore there is the idea or the concept of moat, and what they want is to have the payback time of within 5 to 6 years, and this payback time is certainly short, so they want to have the capital back and then earn already after 5 to 6 years. Another factor that I wanted to point out is the nature of goods and services of the company, where it consists primarily of fees for licenses of the company's software, subscriptions, hosted and maintenance services, professional services, and hardware revenue. If you notice here, these are majority in essence kinds of source of income wherein it is recurring, wherein a company, or if Enghouse has got this company in their portfolio, and then it is a recurring source of income wherein the company will have to continuously require the services and products of the company. If we compare subscriptions, hosted and maintenance services to hardware revenue is quite hard to truly establish, because once the hardware is delivered to the customer or to the client, then the company or Enghouse will have to look for new clients to deliver the hardware to. This is not certainly, or it's not necessarily a recurring kind of source of income, whereas with subscriptions, hosted and maintenance services, and other professional services, these are in essence recurring source of income. This is the total revenue of Enghouse Systems from 2016 2016 until 2020. So if you will see here in 2016, the revenue or the total revenue was only sitting at $308 million. And by the end of fiscal year 2020, they were already sitting at $504 million with CAGR of 10.4%. CAGR is the compound annual growth, or simply, this is the rate of return of the company. You will find here that it has been consistent growth. As a matter of fact, the company is forecasted to grow its revenue by 11.4% every year. And 11.4% really is not a bad forecast for revenue growth. Here in this data, you will find that the gross profit margin and the net profit margin of the company has been growing year on year from 2010 until 2020. From 10.9%, they grew their net profit margin to 19.6% in October 2020 fiscal year ended, and trailing 12 months of almost 20%. These are all good signs of profitability. This therefore is an absolute stable profitability for the company, and what you will find, it is consistent and continuously increasing. If this has been choppy, then I would say that we have to move deeper into this company, but this is consistently growing over the years, and this is absolutely a good information for us to consider. On this table, guys, you will see the ROE and ROIC of the company. So the ROE is the return on equity and ROIC is the return on invested capital. These are always figures that I look at whenever I evaluate a company. According to Warren Buffett considers it a positive sign when a company is able to earn above average returns on equity. Generally, the higher the return on equity, the better. The return on equity above 15% is good, and figures above 20% are considered exceptional. So, needless to say that Warren Buffett always looks at the ROE and ROIC of the companies that he evaluates and invests on. And here with Enghouse, you will find that the company back in 2010 was only sitting at 8.5%, and right now they are sitting at 21% on the trailing 12 months. In the fiscal year ended 2020, they were sitting at 19.8%, and these figures are essentially the same with the return on equity, mainly because the company does not have any debt. It does not have to pay any debt, and therefore it uses all of its capital, its assets, and its equity to reinvest into the company. According to Warren Buffett, 15% is average and 20% is exceptionals. And right now, the company is sitting at 21% in the trailing 12 months. As a matter of fact, since fiscal year ended 2020, they were already there at 20%. So to use Warren Buffett's statements, these are exceptional figures. We are now at Stock Rover, and this is the valuation for Enghouse. The ticker for Enghouse is ENGH.TO, and these are the dividend payments for Enghouse in the year 2007 until 2021. As you can find here, they have been consistently increasing their dividend payments, and in 2020, they were sitting at 0.52, and they increased that through the roof at 310%, almost 311% in 2021, and we are not done yet. In 2021, we are just on the second half, and they are already sitting at $2.12 a share. And here, looking at the free cash flow per share of the company, you will find here that it has been growing. There was 1 year here that I believe 2019 that it dropped, but definitely on essence or in concept, in totality, the company had been growing its free cash flow per share. Now, this is one thing that I would urge everyone to always look at whenever you look or evaluate a certain company. The free cash flow shouldn't be negative. It should never be negative, because the free cash flow is the amount of money or cash the company has to be able to pay its debt, to be able to pay its dividends and everything else in order to expand and operate the company. So therefore, if the free cash flow per share of the company is negative, meaning the company is operating on debt or liabilities. In this case, Enghouse is certainly not operating on debt nor liabilities. It actually pays and acquires businesses, paying it on cash. So therefore, this is a certainly healthy free cash flow per share. share. By the way, I am using Stock Rover application for my valuations. I find this application truly helpful so far with all the apps on valuations that I have used and experienced. I believe that Stock Rover is the best one, or the most friendly, user-friendly one when it comes to various criteria, information, and basis on my valuation. One thing that I truly like about this application is that it tells you the competitors itself, the ticker, the company, and the cap of the company together with the PE ratio. Now, one thing that I want to warn you about PE ratio is that earnings can be manipulated. So therefore, what I truly prefer to look at is the price per cash flow, free cash flow, that is. So then I look at this and have the comparison in the industry here and the S&P 500 as well. So if you look at the price per free cash flow, the company, it actually is a lot lesser than its price to earnings ratio. So many valuations of mine are actually based on free cash flow as well, because again, the PE ratio can be manipulated sometimes. So if you like this application, you can click the link on the description below and you will get a 2-week free trial, and you will find yourself whether you like it or not. But to me, predominantly, I really like it. With all of this information stated and discussed, I certainly believe that Enghouse Systems Limited is the Canadian answer to Microsoft. Enghouse Systems Limited's strategy, acquisition, operation cash flow, and growth strategy are all reminiscent of the strategies of Microsoft, and I certainly believe that this is a good value for our investment. Now, I must say that I do certainly have one concern with Enghouse Systems Limited, which is high goodwill. High goodwill is the overpayment of the company when it acquires certain firms. It has got about 30% high goodwill, and aside from that, everything else ticks the box for me. But guys, again, this is just for me. This is my valuation and the thought process that I have whenever I look at a company and evaluate a company. You will have to do your own due diligence before you buy this stock. Do not invest in a company merely by watching one video. You have to do your own homework. So thank you very much indeed. Let me know in the comments below if you agree or disagree in my valuation here, and I'm certainly happy to be in contact with you and exchange ideas and concepts with you on the discussions below. Thank you very much indeed. I hope that you enjoyed this video, and I hope that you gained value from my video and my channel as a whole. If you did, please share, like, and subscribe, and I certainly hope to see you on my next video.